But obviously, like DeFi in itself, the TVL is going to go massive. There's going to be all sorts of different projects that are going to do well. But I think that people need to make sure that if the project's doing well, make sure that that P&L, that profit, is making its way back into the token holder. So I think there's a lot of projects out there who are great projects, have good product market fit, have users spending real money, but then they're stingy with the token. They don't take the money that they're making and pass it back to us, the token holders. And I think that the market's going to continue to start really punishing these projects. Like, okay, you do well, but your token's not going anywhere until you start buying it back or paying out some sort of continuous yield if I stake your token, which I think is great because that's the whole point. Us, the users, need to get wealthy as we make these product protocols very well used. So I think that's my sort of mental map for this sort of DeFi explosion over the next 2 to 3 years.
Hey guys, welcome to Everyday Finance. Within the context of Bitcoin, Arthur Hayes reaffirms the overarching point that the printing of money on a worldwide scale is structural and not transient. Due to the fact that governments continue to increase liquidity in order to service debt, calm markets, and manage crises, fiat currencies continue to experience a gradual decline in value. Due to the fact that it has a fixed supply and is not controlled by central banks, Bitcoin is becoming an increasingly powerful hedge and alternative monetary system in this scenario. It is abundantly evident that Hayes is trying to convey the idea that this is not only about the current price action, but also about positioning before the next wave of monetary expansion fully hits. The importance of monitoring. Bitcoin at this time lies in the fact that these macro movements do not make their presence known loudly. Rather, they take place while markets are distracted.
It's be very interesting to see what Powell comes out with, because everybody's saying the Fed should cut. You have Trump chirping on him. You have these shadow wannabe Fed governors. Some of them are on the board. Some of them are proposed nominees. And supposedly Powell is this Volcker 2.0 type figure who's supposed to inject some credibility back into the Fed of this, nonpartisan, which is bullshit, non-money printing organization. And so he's got this situation. And on one side, there's an argument saying, okay, there's a labor market. There's all these sort of statistics you can roll out saying this is why the Fed is being too restrictive. But on the other hand, and this is what not that I have a probability weighting between the two, you have human nature, right? And you basically have this person who's been vilified for good and bad reasons in the press by his ultimate boss, the president of supposedly an independent organization. Does he get up there on Friday and say, oh yeah, sure, I cave. We're going to cut 50 basis points on September, was it 17th or 18th? Like, as a human being, as a man, how does that feel to just be completely bitched out and then you have to capitulate on the biggest stage in the world? So I think there's a high probability that while, probably ultimately the Fed will cut at some point, whether it's Powell or whoever else replaces him or whatever, maybe Trump fires him, whatever it happens over the next year. But I think there's a high likelihood that Powell sticks it out and just says, fuck you to Trump and doesn't cut. Just because he's a human and human beings don't like to be put in these sort of situations. And I've been having this argument with a lot of very senior and prominent macro writers who, put all these reasons why Powell has to cut and, why his job is so, uncomfortable being sort of the foil at which Trump launches all these tirades against. But at the same time, what a better way to prove that you are an independent monetary actor than to say, no, I'm sticking with my guns. I think that 4.25 to 4.5% Fed funds is neutral, and fuck you, Trump. And because I'm Jerome Powell, I'm an independent head of the Fed. So I think there's that continuum. I don't know where it's going to come out. It ultimately doesn't matter. But I guess if you're a trader, then obviously this is a very important speech you'll give on Friday. No, I'm still pretty much fully invested, just because, again, I don't have a monthly P&L target to make or a yearly P&L target to make. I don't want to overtrade. Obviously, everyone falls victim to that of sometime trying to take 5 or 10% off the markets. I'm going to buy back in, But you just end up paying more fees to your brokers, and I'm just going to sit back. And Powell comes out and says I'm not raising, or doesn't talk about cuts at all, and market tanks 15-20%. I've got some extra cash, and I'll be going shopping on some things that I think are cheap, just because I think that Trump and Besson are just setting up such a perfect situation for how money is going to be printed post 2026 in May. And I guess listen to a CNBC interview with Zarvos, one of the Fed chair hopefuls, and like if that guy gets in, Bitcoin will be at like 15 million, because he's just going to do yield curve control, printing money, immediate 300 basis point cuts, all sorts of things. So I think Trump and Best have laid out exactly what they want to do: run it hot, inflationary, all these sorts of things. Powell is the only thing standing in their way, and come hell or high water, Trump will get what he wants. The question is, how difficult is it? Whether he has to fire Powell, or there's just ways to do it. Yeah. So, disclaimer: I own a lot of this shit, right? I'm a professional shill, so please, please be cognizant of that fact. So, in terms of the trading space, I think Hyperliquid is probably my number one bet there for decentralized exchange. Decentralized exchanges have been around for a very long time. There's been various projects that have been successful over the years, but Hyperliquid has been the best so far. With a small team, Jeff has been able to, I don't think they hit like $30 billion of trading volume over a few days ago. Yeah. And the best part about Hyperliquid is they've rolled out this permissionless ability for developers to launch their own central limit order book perpetual swap markets. So now, as long as you want to operate a front end, it's almost like the online gambling thing, right? There's one company that basically creates all the games. Every other thing you see on the internet is basically just a marketing company. They change the colors, they've got top of the funnel analysis, blah, blah, blah. They all sell the same games that are owned by the same company. I think that's going to be like Hyperliquid. Everyone's going to have sort of a front end to appeal to their particular market that they know how to market to. And they might offer a certain sort of incentives, but at the back end is going to be this high performant, decentralized central limit order book that's literally just tech. That's the holy grail. Many people have been working on it. I think that the Hyperliquid team is probably the closest to actualizing that. And then they're also getting into the new issue market. So, the big thing in crypto where exchanges make a lot of money is offering new tokens. Yeah. And it's a pretty fucked up process because me as an advisor to token projects, I have all these projects and they're handing off 5, 10, 15% of their token supply to the large centralized exchanges to get access to their clients. And it's a bad deal for the rest of the token holders because there's less tokens left to incentivize people to use the applications. And so I've been on my, high horse trying to tell projects, why are you paying this exchange all this money? But now there's Hyperliquid, and they showed how potent their offering was with the Pump.Fund launch. They launched a pre-market perpetual swap, which was the largest trading perp pretty quickly. They allowed people to receive their I believe their pump allocations through Hyperliquid, and then subsequently launched a spot market, which was, I believe, the most liquid spot market, or is the most liquid spot market for Pump.Fund. So I think, and it didn't cost projects 10% of their circulating supply to get access to this. So we're going to see a democratization of the new issue market. We're going to move back towards a 2017 more free-flowing ICO situation powered by Hyperliquid. I'm sure they're going to have some copycats doing this as well. So it just reduces the fees and the friction in the ecosystem. So I think that's the exchange to beat. And the best part about Hype is they take 95% of their P&L and they buy back their token. And so you basically have this billions of dollars of money that's going to flow back into the Hype token, and it's going to help make the traders who are trading wealthy on this platform. So I think that's a good one. EtherFi, as I mentioned, sort of this neobank, a cash card. How do you spend your crypto offline? If you've got all these stable coins, now what do I do with them? I think they're going to help with that. So those are the three main things. But obviously, like DeFi in itself, the TVL is going to go massive. There's going to be all sorts of different projects that are going to do well. But I think that people need to make sure that if the project's doing well, make sure that that P&L, that profit, is making its way back into the token holder. So I think there's a lot of projects out there who are great projects, have good product market fit, have users spending real money, but then they're stingy with the token. They don't take the money that they're making and pass it back to us, the token holders. And I think that the market's going to continue to start really punishing these projects. Like, okay, you do well, but your token's not going anywhere until you start buying it back or paying out some sort of continuous yield if I stake your token, which I think is great because that's the whole point. us, the users, need to get wealthy as we make these product protocols very well used. So I think that's my sort of mental map for this sort of DeFi explosion over the next 2 to 3 years.
Strategic. The Bitcoin treasury firm owned by Michael Saylor is getting close to a vital valuation line which investors are concerned about. The stock has experienced a slight increase of 1.2%, although it is still almost 66% lower than its highs from the summer of last year. MNAV, which is the ratio that compares Strategy's market value to the amount of Bitcoin it possesses, is the most important issue. It is uncomfortably close to 1, which is the threshold at which the corporation would be valued at no premium to its Bitcoin reserves. And it is now trading at approximately 1.02. The investment reasoning undergoes a significant shift in the event that MNAV falls below 1. A straightforward issue arises. Why would investors want to hold the stock rather than directly own Bitcoin? This is because investors would be effectively paying additional risk for less reward. This scenario has the potential to generate selling pressure and establish a feedback loop characterized by a decline in confidence. Strategy's market value is approximately $47 billion, while its Bitcoin assets are worth close to $60 billion. This is a strong indication of the conflict that exists between the two. Additionally, the average price at which the corporation purchases Bitcoin is close to $74,000, which adds to the danger. A significant amount of stress will be placed on the accumulation strategy in the event that Bitcoin falls below that level, particularly for traders who do not have a long-term conviction.
Well, it's the same as any other, smart contract blockchain. I'm not going to say layer 1, 2, 3. It doesn't fucking matter what layer you are. Solana had product market fit with meme coins, and that was what drove the really the narrative from $7 to it was like $2.80 or whatever it got up to. Now you have Tom Lee on Western financial media beating the drum about Ether and Joe Lupin.
We're going to get to that.
Things. And so again, they're all competing for the same thing. We all do the same thing. You could say one's faster than the other, one's more secure than the other. Take your pick. If you're very deep in these protocols, you could probably make an argument why yours is the best for most of them. It's just going to be dependent on where the clients. So Solana needs to find a standout application that's going to have lots of users who are going to drive transaction flows. Yeah. If meme coins come back, maybe that'll be it. I don't know what that catalyst is going to be, but I think that's a challenge for Solana or any other blockchain. Ethereum is a bit different because if you think about it, basically every single major category defining project in DeFi starts on Ethereum. They don't start on any other network. Ethereum has the most developers, has the most commits. Yes, Solana's number 2, I believe. But again, they have a mind share that everyone else is trying to compete against. And so I think that's just going to be challenging for all these other blockchains, especially if ETH starts breaking through 5,000 and you get sort of this massive ETH bull run, like what is it that they're going to offer to the mind share to get traders to buy their token? So I think at the end of the day, everyone's trading the forward on sort of the MicroStrategy play. So obviously Saylor has hit it perfectly out of the park. I think, is he in the NASDAQ or S&P 500, whichever index? I'm not sure which one he's in, but that's the goal, right? It's get the passive indexers to have the set it and forget it flows, right? I think the Capital Group is like one of MicroStrategy's largest holders. Who would have thought Capital, this like stodgy, long only fund manager, owns like one of the most, leveraged, financially engineered equities in the world. But there it is. I think it's some insane amount of flows. But why could they have to? They have an index. The index says this: I have to buy these stocks, whatever's in the index. I don't care about any other metrics in the business. And you can say that's a bad thing or good thing, but that's just passive investing, and that is the ecosystem in which Western financial markets are in. And so that is what these DAT companies, at least the ones that are going to be successful, who will have an MNAV above 1 for a long period of time. That's what you're trading. You're saying, I'm a retail investor. These things are not in the index yet. But if this company is able to have a certain amount of average daily trading volume, if the market cap is above a certain level, if their industry on Bloomberg is X, then this cohort of fund managers has no choice but to buy this stock. And they could even hate Bitcoin and think it's going to zero or whatever the shitcoin is that is in the treasury. It doesn't matter. Their job as a fiduciary is to match the index.
Yeah.
And that is the play. And that's all it is. That is why people are paying $2 for $1 of earnings or assets. That's it. And so I don't know how successful any of these DATs will be. Obviously, I'm an advisor of UPXI, and this will be my advice to that particular companies. Understand who it is your end buyer. And it's not, Robin Hood retail Muppet. It's, dude in a Brooks Brothers suit in Connecticut at the golf course who doesn't know anything other than like just buy the index. That's it. Because once you get into that flow, it doesn't matter what your company does. As long as you're not committing fraud or doing something else, the stock price is just going to go, you're going to get inflows. And so I think that's the challenge for all of these DAT companies, is to get their trading volumes and their market caps high enough so they get included into indices. That's the game. I mean, it stops when you can't get into the index selection criteria. And I haven't really done a lot of deep dive on obviously you have passive indices, you have specific indices like Russell or whatever. Then you have all of these like pseudo active managed thematic funds like, Vanguard X, whatever, some technology thing or whatever. Right. So like if I was a retail investor putting a lot of money in this for long-term and not just a momentum trading thing, it'd be, okay, well, let me identify the pools of money where I think that one of these could be included into. Okay, what are the rules? What are the dates? Understand like what companies come in, what companies go out. Like it's, I didn't trade this I was at City of Deutsche, but it's like rebalance trades, right?
Yeah.
What's going in the index, what's going out, what are the flows? Let me make a prediction on that. Okay, I'm willing to pay this premium for this particular stock. Now, obviously, as we're humans, we want to trade the most liquid thing. So it's going to be, a power law distribution in terms of who's going to be successful. So we might have one or two successful DATs per security, per crypto. And so then it's obviously comes down to a, marketing game, who's showing the loudest, who's on TV the most. And that's why obviously everyone is showering money on BitMine because, Tom Lee is the main character right now in the ETH space. And that's what has to happen because, I'm going to trade an ETH DAT. There's multiples to choose from. Which one do I know? Oh, I know BitMine because I saw Tom Lee on TV. Okay, I'll buy that one, right? That's the simplistic sort of thinking that an investor is going to happen. But again, we're all literally trading this forward of, okay, when the index inclusion comes up in 6, 12 months or whatever it is, okay, does BitMine get included in Russell 2000 or, technology fund, whatever, X? That's the goal.
The acceleration of Bitcoin's price above $90,000 has been anything but flawless. Immediately following dramatic global headlines regarding U.S. strikes in Caracas and claims surrounding Venezuela's leadership, Bitcoin BTC dropped back below $90,000. This occurred after the cryptocurrency temporarily pushed toward $91,000 because traditional markets were closed. Cryptocurrency was the only asset that was able to withstand the shock, which increased volatility in the danger of strong whipsaw fluctuations. Although there has been turmoil, bullish enthusiasm has not completely disappeared. A significant number of traders consider the retreat to be geopolitical noise rather than a structural regression. Upward targets ranging from $96,000 to $100,000 are still very much on the radar, provided that crucial support continues to hold. Technically speaking, the 21-day moving average that is close to $87,850 is quite important. Maintaining a position that is higher than it ensures that the January uptrend will continue. Traders are also keeping an eye out for a potential gap in the CME futures market above $90,000, which is a level they frequently return to. The recent decline in the price of gold, which occurred after it reached its highest point in late December, spurred conjecture that capital is shifting into Bitcoin. Once futures markets are back in operation, a rise in activity may resolve this breakout in a short amount of time, not over the course of weeks, but possibly within hours.